Well, good afternoon, then, folks, as we head into US trading on Thursday, the 6th of July. And it's more the same as we were talking about this morning. Obviously, we were speaking this morning about stocks being under pressure, US dollars kind of being under pressure to start the trading session off the back of worries about how continued interest rate hikes will impact the economy going forward. Obviously, in relation to the minutes last night, that continues to be a problem. It has been a problem. It has been a problem for a while. Markets didn't seem to really think of it as a problem for a while, but in recent trade over the last couple of weeks, markets are starting to wake up to the fact that interest rates at these levels are not a positive for them. They're not a positive for markets, and stocks under pressure going in line with those China and US developments over the course of the evening as well, which obviously we have alluded to in this morning's session. More of the same from that. A bit of a pop to the top side in sterling over the course of today. I was listening to something on Bloomsbury earlier on, suggesting that JP Morgan, I was speaking yesterday about JP Morgan expecting interest rates, or saying interest rates could potentially even reach 7% in the UK, and money markets price in are fully priced in now at terminal rate of 6.5% come March of next year, right? And that is obviously substantially higher, another 1.25% higher than where we are currently at in terms of the Bank of England's interest rate decision. Andrew Bailey continued on this morning saying that there is no end in sight in terms of interest rate hikes, so interest rates likely to continue on higher in the UK for some time just yet, and sterling has popped higher over the course of today, which it's a little bit tricky for me to wrap my head around personally. I mean, come back here to this grid back here. If we just cover this before we jump onto some individual charts, I mean, we can see stock indexes lower across the board in line with what we were seeing on over the course of this morning in this morning's video. You can see bond yields, yields higher globally now. There's a couple of mixed ones this morning, but yields higher globally, which is expectations for interest rates rising globally. You can see the US dollar somewhat under pressure. FX land is not going in line with that negative risk sentiment pouring over, or hasn't poured over from equity markets, albeit Japanese yen is slightly higher across the board, which is a positive, which is kind of goes in line with that rejection of the 145 round number on dollar yen, which is a line in the sand potentially for some Bank of Japan intervention. Now, this is not intervention. This is not clear smash dollar yen lower and buy a load of Japanese yen. You have to imagine it's just a bit of profit taking on the move higher, or the moves higher, that we've seen in recent weeks. You can see our recent months as well. You can see the performance of the Japanese yen in and across here. You can see year to date down massively, 3-month percentage change down massively, month to date percentage change down substantially as well. So a lot of downside when it comes to the Japanese yen over the last number of weeks and months in markets, and a bit of a pullback off that 145, a bit of profit taking and a bit of a move to the top side in the Japanese yen, and a bit of downside on the US dollar side of things is it's not too unsurprising, really, to be perfectly honest with you. But FX land's not really moving as cleanly as the stock indexes, which you can see stock indexes across the board continue to remain pressured. You can see the DAX and the FTSE continue to smash lower, the Nikkei continues to smash lower. S&P, the Dow Jones, the Nasdaq and the Nasdaq. S&P and the Dow Jones, mixing up my words. The S&P and the Nasdaq do not have the same sort of aggression to the downside as the Dow Jones and the Russell do, certainly in the US side of things. But stocks continue to be under pressure globally off the back of this situation across here. You can see US bond yields rising higher, the 10s and 2s both rising higher. You can see German bonds and shots 10s and 2s pushing higher. You can see the UK 10-year yield, the UK 2-year yield continue to push higher. I think that's an interesting one when it comes to the UK 10-year, which is obviously Gilts, which we'll have a look at now in a minute. But FX land, you can see this pop higher in sterling, which has resulted in obviously a bit of a pop higher across the board in the US dollar over the last hour or two, which is that a lead up or a lead into the data, maybe a bit of kind of position squaring into the data over the course of the rest of this afternoon and into tomorrow, which we obviously have touched on this morning's video. But I think this is an interesting one to keep an eye on when it comes to the UK side of things. I mean, if I just go and have a look at I can look at a weekly chart and look at this. I remember back when these yields went through the roof. This was when Liz Truss and Kwarteng nearly blew up the UK economy, and pension funds there's talks of pension funds failing and losing substantial amounts of people's pensions and stuff. But that was the exact level that it reached was 4.632 in terms of where we're at. I don't know what has the price taken off. Let me see. Let me get this back on. Symbol last price. We're at 4.592, 4.593. So we're 4 percentage points away from where we were when the Bank of England had to intervene and buy a bunch of gilts. Now, back here in September of last year, October of last year, this was like the whole world was ending. Well, not the whole world was ending. It's like the UK economy was about to blow up, and everything was all doom and gloom, and UK no longer be a country, and there was a lot made of that back there, and now all of a sudden we're back at this level and nobody's even speaking about it. Sorry, I mean, I don't really get why people aren't speaking about that when markets are up there. I'd be interested to see how markets react to that. Do the Bank of England come out and suggest anything? Do the news sources even start speaking about it? I don't really know, to be honest with you. Maybe it's due to the fact that terminal rates are expected to be higher, but pension funds this caused such an issue with yields being at this percentage back then. I don't know why it's any different now. Even if expectations for interest rates are to be higher than they were back then, still doesn't take away the fact that markets were in trouble, or the economy was in trouble with interest rates at this point. Now we're back here. I don't know really, to be honest with you, why that is not being spoke about a bit more than it is, but that's something I'm going to keep an eye on personally over the coming days and weeks, with this 10-year yield, with yields on gilts being up at this level, the level previously deemed far too high by the Bank of England, where they actually had to step in and intervene and purchase a load of gilts. Let's see how that plays out over the coming days, weeks. Let's see if the Bank of England do react, if that decides to rear its head, and you'd have to imagine that is not likely to be positive for sterling. If we have a look at the cable chart just while we are here, you can see this was the move, a substantial move lower when that was a thing back then, but now sterling's just rallying, and it's a lot to do with UK economy is doom and gloom, but maybe this is rising off the back of interest rates pushing higher. But if UK terminal rates in the UK have a terminal rate of 7% or 6.57%, that is not likely to be positive for sterling. So my guess would be that ends in tears at some point, but if it does, we will try and take advantage of it. But that's where we're sat heading into US trading today, where we've got ADP employment figures out in 15 minutes from now. We have jobless claims out at 1:30, and then we have some PMIs out later on this afternoon at 2:45 and 3. So a slew of economic data from the US. Obviously, a couple of these are delayed a day because of the bank holiday due to the Independence Day. So we'll have to see how this plays out. A raft of US data, some labour market figures in the lead up to NFP and the unemployment rate tomorrow, which obviously takes centre stage as we head into tomorrow. But the economy remains resilient in the US. If we get some negative data, it probably should prove some further downside in the US dollar. But I think one of the terms it means about stocks, you just have to think about it. You get a bunch of weak economic data that will obviously contribute to inflation coming down. Inflation expectations, in advance of current day are well anchored. They're not expected to rise further. Inflation expectations now. Inflation is not pushing higher. It's pushing lower. Do we come into the second half of this year and not push higher in terms of inflation? We get some poor economic data that will cause the Fed to backtrack on their interest rate hikes. I know we had a hawkish minutes last night, but they can't really say anything else without sparking further fears of inflation. I just think in terms of a risk sensitive sentiment point of view, some negative data spark some upside in stocks over the course of the rest of this week. Maybe some potential for that, but there's some downside in the dollar, upside in stocks. Maybe not the worst way to play it, but I'll be more confident on the US dollar reacting how it should to economic data going forward. So something to keep an eye on, or a lot of things to keep an eye on over the course of the rest of today and into tomorrow. Once we get into tomorrow, into NFP, we'll be sure to update further in future videos over the next day or two.